Welcome to Chit Chat Stocks. Before we get to this episode, we want to talk about our friends at Public. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. That's no commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. Public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome in. This is the Chit Chat Stocks podcast. My name is Brett Schaefer, and as always, joined by Ryan Henderson. This week on our Wednesday episode, we have one of our investor study, investor overview episodes where we look at a famous investor or maybe someone that is not so famous that has a fantastic track record, someone that essentially has some stuff out in the public sphere, stuff on the internet that we can study and try to learn from. And this month, we're doing Peter Lynch, perhaps the most famous investor besides Warren Buffett, someone who has beat the market with common sense, went on a fantastic run in the 80s and 90s, and then retired. We read the book One Up on Wall Street, read some of his other stuff, read a lot of his work, and now we're going to condense and have a great discussion, look at some of his insightful quotes, come up with some segments on the stuff he looks for, his criteria, some examples, his investing style. And then we're going to have some discussion questions and talk about how it relates to today. We're going to talk about what we learned from studying Peter Lynch and what we hope the listeners can learn from as well, because it's always important to learn from the historical greats. And for someone with his track record, I think there's plenty to learn. There's not too much to worry about there. So before we get into it, you can read any of this report. Well, I wouldn't call it a report. There's basically show notes. We'll have some quotes. We'll have some links. We'll have some of our thoughts and discussion questions on the Substack, which is a free newsletter that goes along with this podcast. That'll get sent out, and the link is in the show notes. But before we get started, Ryan, maybe any teaser or quick overview or your initial thoughts for this episode on Peter Lynch?
Yeah, I guess it's a little bit of a teaser. I think of all the investors we've studied, Peter Lynch's approach, aside from the scope of like the amount of stocks that he covered, his approach and his process seems the most replicable for the average investor. This isn't activist investing. There isn't a quantitative element that the average investor can't copy. His process can be applied to any investor's process. You can certainly take away some of the attributes that he looks for in businesses. So I thought that was kind of fun. He's a really good writer. He is very good at communicating what to look for in stocks. And the other thing I liked about Peter Lynch is sometimes great investors are a little bit of weirdos. They're kind of very, very nerdy or very, intense, I guess. And I thought Peter Lynch was just kind of a funny, seemed like the kind of guy you'd want to work for if you were in the investing realm.
I agree. Yeah, that's a great tease. And I think from the title, we'll probably have something around beating the market with common sense stocks or something around that. And that really sums up what his strategy is. Look for common sense things, invest in them, and hold for the long term. The most probably inspired from Peter Lynch, and probably maybe the most famous investor of the 21st century that was inspired by Peter Lynch, would be the Gardner brothers over at the Motley Fool, who we will probably study one day as well. But let's move into Peter Lynch. I'm going to do a quick biography. I know this part can get boring, so I'll try to make it about 1 minute, 2 minutes here. He was born in 1944 in Massachusetts. His father died when he was young, which meant he had to take up caddying to make money for his family while he was a kid. And then as a caddy, spoiler alert, he learned about investing in stocks. He then went to Boston College, got an internship at Fidelity, and then eventually became an analyst at Fidelity at the age of 25. Likely due to his strong investing acumen, he was put in charge of the Fidelity Magellan Mutual Fund at 33 years old, so pretty young, but I guess not too young to be in charge of a mutual fund. This was in 1977, which I will say is one of the bleakest periods for equity and stock investing ever for the United States in the last 125, 150 years. I think this is kind of probably not a coincidence that Druckenmiller started around this time as well and had fantastic returns. And then Peter Lynch ran the Magellan Fund until 1990. The fund returned 29% per year when Peter Lynch ran it, or around double the S&P 500 over the same time. It started with $20 million in assets in 1977 and had $14 billion in 1990. So a strong investor and money manager and marketer. I think this book is one of the best marketing materials for that fund. And I think he wrote it right when he was preparing to retire in 1990. As a side note, though, I'm curious what you think about this, Ryan, or whether you saw it when researching Peter Lynch. The average investor who put money in the Magellan Fund actually lost money. Why? Because people pile in after really strong performance. So I'm guessing after they had, say, a year that went up 40, 50%, people piled in. And then, well, he probably didn't have that good of a year after that, even though the long-term track record for the fund was 29% per year, which is really, really good. I mean, no matter what the fees are, that's going to be great. I think that's a lesson in betting on the right jockey before the race starts, but not after they've won the Triple Crown. What are your thoughts on that, Ryan?
Yeah, I think this is probably the case with a lot of either securities or funds that have had good performance and then came down, is just so many people are piling in at the top. It's not too surprising. The other part here is $14 billion in 1990. That's a big fund. And with his diversified approach, it maybe would have been a little bit harder. And we're going to talk about how he liked to skew towards smaller stuff. It maybe would have been a little bit harder to generate alpha at that size. Although I don't think I think he said even at high amounts of AUM, he was able to perform pretty well throughout the book, but it obviously becomes just a tougher game. You know, in the back of your mind that if you buy a certain stock that's whatever, $100 million in market cap, and you buy 5%, it's not going to move the needle for you. So maybe it kind of pushed the goalpost or pushed what he was looking for.
Yeah, and again, 1990. It wasn't 2000. It was 1990 before one of the biggest bull markets of the last 100, 150 years. Let's get into the basics of Peter Lynch's investing style. We're going to just go through the synopsis, and then after this, we're going to go through different examples, examples, and then try to relate it with our favorite quotes and examples from historically to the current day and what we can learn from it. So, Ryan, I've been talking a lot, so why don't you go first on what you thought the basics of his investing style was?
Sure. So one thing that you mentioned in your notes here is that, and spoiler alert, you thought he was pretty mentally flexible. So I really agreed on that part. It's not necessarily that he would just pivot to whatever he thought was the great investment at the time, but he had sort of his core attributes or his core characteristics of what he wanted in an investment. But depending on the environment, he was willing to buy other types of securities. And he actually goes through in his book, I think it's 6 different buckets that he groups companies into. I don't have them all in front of me right now, but it would be, the fast growers, the stalwarts, the spin-offs. I think there were 3 others that I'm kind of blanking on, but
asset plays, right? Or was
asset plays,
real estate asset plays. That might not be as relevant today, but maybe not. Maybe it's just not something we ourselves are looking into.
Yeah, there were companies that were he invested all across that spectrum. He tended to skew most towards what he thought would be the fast growers, but he was not afraid to invest elsewhere. So in that sense, I thought he was very flexible. He also, I'll go through kind of how I guess I would describe some of the characteristics of his process. So one thing he loved was underfollowed stories, underfollowed companies. He talks about this a lot throughout the book. He likes when companies are dull, boring, analysts don't follow them. So he was kind of looking under pockets of the market where most people weren't, or maybe got too bored. The second one, he prioritizes growth. I showed this. It doesn't, or I spoke about this earlier, it doesn't preclude him from investing in something if it's not fast growing, but he really values a long reinvestment runway, which is also something you mentioned in your notes. And then the other thing, and I think this is probably what I'm guessing most people take away from Peter Lynch, is he loved anecdotal evidence. He loved to kind of try to feel like a part of the company. He says
Boots on the ground,
yeah,
right?
boots
For
on the ground.
example, the La Quinta one, which was, I think, one of his big winning investments back in the day when it was a really big growth concept. He said, well, even though it's not usually where I stay, I went and stayed for 3 nights, investigated the pillows, investigated the pools, made sure everything was on the up and up, and got a good feel that this was actually a quality business. And what the management was talking about lined up with what I saw with my boots on the ground. That's what people, I think, mean by when they say boots on the ground today. They're taking a lot of that from him.
Yeah, I mean, people will even, I don't know if this is that common, maybe it's just in investing circles, but they're like, oh, I took a Peter Lynch approach or whatever. I went and like got the experience. And he even says like, I can't remember the exact quote, but it's, I try to think like an amateur, or I try to invest like an amateur as much as possible, like getting back to the basics, understanding the business. And he really talks a lot about looking around looking around his world, what he's spending money on, what his daughters or his wife are spending money on, and that kind of thing as sort of his lead for new investments. So he values that a lot. And then I put here, don't interrupt the compounding. He likes to let his winners run. If you read his book, you will realize he says the word baggers like nonstop. He loves when things become, multi-baggers, 10 baggers, 20 baggers. And that's really what he's looking for. And we'll talk about maybe why that is and why he was able to do so well with those. And then the last one is just he was willing to do, or he was able to do really well while being very diversified. He says at times he owned upwards of 100 stocks. I think at one point he owned more than 150 savings and loan companies alone. So it's like just saving in the loan companies. So he was buying more of a basket in that sense. And that doesn't mean it has to be equal weighted, but it just goes to show that you don't have to be super concentrated to have outsized performance. And I said this earlier, but just in general, I thought it was very refreshing to look at Lynch because it feels replicable for the average investor. Aside from probably needing a team of analysts to track whatever 200 stocks, he kept it simple. He was always able to boil it down to the few factors that mattered most. And he never, maybe he did, but it didn't seem like he did. He never got analysis paralysis, which is something I do all the time, where you do so much digging. You feel like you have to understand every little facet of the business, understand every nook and cranny of the investment case. And he kept it really simple. And it really worked for him. And typically, I think it just goes to show that you'll learn more about the company as you own it. So you don't have to know everything, every single thing from the get-go. And he just did a really good job of that. What did you think about his overall philosophy, strategy?
Yeah, so I have a list of 5 things. I will say from the things you talked about underfollowed stuff or under maybe discussed things. I think an example today is if you spend time on either Twitter/X or Substack, and you're following something that no one is writing about or no one is discussing, that could be a good sign, because there are some stocks that always get kind of in the it's almost like the zeitgeist, the stuff that people are talking about at parties. I mean, that would be the AI type stocks today, or anything really. It kind of has a different feel every year or two. And then another one is when you see a 50-page research report, that doesn't necessarily mean it's better than one that's 2 pages. And I know we're about to do an hour-long podcast here, but it's a little bit different, where I think the discussion, we kind of go off on different tangents. But just because something is long, it might actually be a waste of time for you to read. But let me go through my list. So without finding any direct quotes, I believe he wants to build a portfolio with stocks that have one, a good story that he has validated and or believes in. Like Ryan mentioned there, boots on the ground. He validates what they're saying, what the numbers are saying versus what he sees out in the real world. Two, a business model he can understand. Him and Buffett are very big on that, only focusing on things that they can understand. If you're an expert on biotech, you might invest in biotech. But for him and for us, we focus more on consumer goods and stuff like that.
He did, yeah. He was willing to expand his circle of competence, though. Like I guess if you own 100 to 200 stocks, whatever it is, you got to invest in. It's not necessarily something that he doesn't understand, but he's willing to advance his understanding of it. He doesn't just write it off because it says they sell medicine or whatever. I think even he talks about a couple of pharmaceutical companies in the book that he mentions. I don't know if he ended up owning them, but he uses them as examples. So it seemed like he invested in things he could understand, but he was constantly willing to try and expand his circle of competence.
Yeah, less stubborn than Buffett, where it's only financials or consumer goods companies, right? He was definitely willing to have a little bit more flexibility there. All right, third thing on his list, I think this is important, something that we focus on discussing a lot here, is a long runway for reinvestment or growth. Fourth, focus on small, undiscovered companies and sectors, and inverting that, avoid buying what's hot. Today, for example, if after reading this book and his stuff, he would be not touching anything AI whatsoever. Do you agree or disagree with that?
Yeah, he talks about everything the kinds of stocks that he tries to avoid, and I could not help but think Nvidia, or super microcomputer, anything data center AI related that's so hot right now. That was the first basket of or the first theme that came to mind. And the other thing I thought about was because he has a section in his book which is like the stocks I avoid, and it's basically like whatever the hottest thing is. And I thought, well, if I mention Nvidia in the podcast, of course it is the hottest thing. It's one of the largest companies in the world. But people will say, oh, it's different this time. The runway is all there and all that stuff. And it's like, that's why anything becomes the hottest thing. That's why companies grow, to huge market valuations and stuff like that. So it's always easy to rationalize why something is so hot at the time, but he did just fine by avoiding those.
Yeah, let me close out with my fifth one, which maybe you'd think would contradict the last one, but honestly, I don't think it does. It is, and perhaps the most important thing, letting his winning stocks run, like Ryan mentioned too. If he bought Nvidia, for example, 10 years ago, would he still be holding today? Maybe. We do have a section, actually the next section, discussing why he cares so much about size and market capitalization versus any sort of valuation and growth prospects he's going through. But I don't think it would be out of the realm of possibility that he would still be holding an Nvidia, a Costco, a Chipotle at a pretty absurd multiple today, but he definitely wouldn't be buying. It's kind of in that no-go zone. All right, I think I have maybe some other things here. Well, okay. Ryan mentioned this too, but he talked about having flexibility and moving into where things are cheap. And, he talks about real estate and asset plays, timing cyclicals, special situations, promising subsidiaries of a larger company that people aren't really focusing on. There could be spinoffs along with that. I like this a lot because if you only have the focus on small, undiscovered companies, long runway for growth, basically focusing on growth stocks, well, when you get to eras like 1999 or 2020 and 2021, you're going to be stuck and you might make a lot more mistakes, whether, if you have the skills to invest in other assets, well, okay, during that time period, it might be better to have that flexibility. I think a lot of people learned that lesson. We did as well in 2020 and 2021. All right. Anything else on that, Ryan, before we move to the next section on valuation?
No, let's talk about why size matters so much in his process, because he talks about this a lot.
Yeah, so he does care about size. And when he says this, he means essentially just market capitalization or enterprise value. So his strategy is to find as many companies he believes have a good chance of being 10 baggers, that stocks, stocks that go up by 10x in value. And it is much easier to find this in companies with smaller market caps. Here's a quote about the internet bubble in the 1990s. Quote, on the following page, I also mentioned the bloated 500 times earnings shareholders paid for Ross Perot's electronic data systems. At 500 times earnings, I noted it would take 5 centuries to make back your investment if EDS earnings stayed constant. Thanks to the internet, 500 times has lost its shock value, and so has 50 times earnings, or in our theoretical example, 40 times earnings for .com.com. In any event, to become a $100 billion enterprise, we can guess that .com eventually must earn $2.5 billion a year. I put my own parentheses in there for 25x reasonable earnings multiple. Only 33 corporations earned more than $2.5 billion in 1999. So for this to happen to .com, it'll have to join this exclusive club of big winners along the likes of Microsoft, a rare feat indeed. So I would adjust that to today's dollars, right? That's a little smaller than maybe he would give an example for today. And .com is not a real company. That was just a fake example of kind of the .com naming stuff, which you can probably relate to today with things that just have AI in the name. But I thought this was a great example where if this company, a fake company, .com, is trading at $100 billion market cap today, and you think it has a chance to earn $2.5 billion if things go right within the next 5 or 10 years, that makes no sense to buy, because you have capped upside, because a company can only earn so much versus how big it is relative to the global economy and versus its sector, its niche, whatever it's in. If you think you can earn $2 billion, even $1 billion in the next 10 years, it might make sense to buy it at a $1 billion market cap. It might make sense to buy it at a $5 billion market cap, even if even if they have negligible sales today. But then if you're buying it at $100 billion, that's pure foolishness. And that's why I think he focuses on, and I think I don't invest in too many of these type of things, but I don't think I'm opposed to investing in, a basket of, say, high risk, high reward, growthy, small cap stocks. But I want them to be small caps. I want them in today's dollars probably below a $5 billion market cap with a huge potential runway, because a lot of them will be failures, but the ones that win will be 10 baggers and, maybe even 100 baggers over the next few decades.
Yeah, I like the way he describes that. And I think in general, like, if you're buying large market cap companies, and I'm in this boat. I own Amazon, which is what, probably $1.5 trillion now, maybe a little
Yep.
higher.
In between $1.5 trillion and $2 trillion.
It's not that you can't own them, because he owned the stalwarts, but your expectations need to be revised. You're not owning that for it to be a multi-bagger. You're owning that for it to be resilient, because it is deeply advantaged and you can generate maybe above market returns, but you should not expect, like, I don't expect Amazon will be a 10 bagger. If it is, great, but it's highly unlikely.
Yeah, and if it is, maybe over 20 years or something like that. Here's what I think a lot of people miss, though, when investing in large cap stocks that he hits on, I think a lot of people could learn from, is a, say, market cap threshold for something that trades in a current nosebleed multiple. And I ask to you, do you have any sort of market cap threshold when buying, say, a growth stock at a nosebleed multiple? Because I know Amazon, if you look at the forward multiple, it's not something that's extremely expensive at 50 or 60 or 70 times earnings. But I remember looking at something like Snowflake, $100 billion market cap. They were projecting like $1 billion in cash flow within 5 to 10 years. And I think those have honestly come down. The company is not doing as well as people thought. Or Shopify, $200 billion market cap, probably the same. Like, you could say, hey, I think this business will generate $5 billion in earnings in 6, 7, 8 years. What do you think on that? And do you think people should have that? And maybe I have a follow-up on the Magnificent Seven.
Yeah, I mean, it's kind of the worst of both worlds, right? You're getting huge market cap and huge huge multiple, so they had to fulfill those expectations and then some, which is harder and harder as the company gets larger and larger. So I guess the two kind of go hand in hand. But yeah, I think we talk about this all the time, which is it's okay to invest in a company where the earnings aren't there, but you should get paid for that risk because it's not always certain that they are going to earn money in the future. So you definitely don't want ones where you're betting on a huge change in profitability and it's already baked in. That's kind of the worst case scenario.
Yeah, and I can already hear maybe the QQQ boys, the growth guys from today listening to this and saying Peter Lynch was proven wrong. The Magnificent Seven has been large and has grown and has had a premium multiple. Do you think he would have changed his mind with that, or do you think people are looking at maybe a few exceptions to the rule? Because I personally think there was a few miracles that let Tesla survive. There was a few, maybe it was very fortunate circumstances that NVIDIA has been such a monster winner. And if you look at Alphabet, it hasn't really been that expensive, or Apple, except for, honestly, it's probably the most expensive it has been today.
Yeah, I guess he has been wrong. If you look at it, Magnificent Seven 10 years ago or 5 years ago, whatever it is, it's, vastly outperformed the market. The question I think you just have to ask yourself is, what can this company grow at? In Apple's case, I don't think it can grow that quickly. It might be able to grow earnings the high single digits, but that's I'm talking high single digit percentage, 8 to 10% maybe in a best case scenario over the next 10 years annually. They just serve a huge chunk of the world already, so it's really hard. Amazon and Google, companies like that, I think they still have, well, I mean, Google's obviously quite large, but Amazon, like AWS, for example, when it's a huge earnings driver for the business, I think you could probably forecast earnings growth to be a little quicker than the maker of iPhones and something like that. So I think cloud has probably been the one factor that's really hurt Peter Lynch's argument in this case, because it's been when they have these huge runway businesses where they can invest endless amounts, it allows them to kind of rebuild their S curve, if you will, where they can kind of tack on extra earnings growth.
Yeah, and I think if Lynch was hearing us, he would say, well, no, I would be flexible and look at what I've said previously numerous times about the reinvestment runway. And he would say, look, these companies had the largest reinvestment runway in history. Therefore, it's not terrible to buy them at a $500 billion market cap. All right, let's move on to the next section. And this is the most fun one because everyone likes growth. Everyone likes fast revenue growth. Ryan, why does he like growth? Why is it important for his investing style?
All right, new sponsor alert. This episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fun letters, podcasts, and more, they collect and summarize the best stock pitches and bring them to you in a single place. Think of it like a modern value investors club. I genuinely use Yellowbrick every single week here to try and discover new small cap ideas for the weekly Power Hour episodes that we do. And the best part is you get tons of features for free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker that you're interested in. You are bound to find a great report on just about any company. That is joinyellowbrick.com.
Earlier in the show, you heard us talk about the investing platform public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing's options not suitable for all investors and carry significant risk. Full disclosures in podcast description, U.S. members only.
Yeah, Brett's going to touch on ways to detect how companies, like ways to detect companies before a growth phase, but I'll talk just briefly about why it's important. So here's a quote from this book. He says, "You won't find a lot of 2 to 4% growers in my portfolio because if companies aren't going anywhere fast, neither will the price of their stocks. If growth and earnings is what enriches a company, then what's the sense of wasting time on sluggards?" Keep in mind, when he mentions growth, he is talking about growth in earnings. However, the easiest way to get long-term growth in earnings is to grow your sales. So I think probably Lynch probably witnessed this early on in his career. I know he talks about KFC when he was a research analyst at Fidelity. One of his higher ups talked about the growth runway at Kentucky Fried Chicken, and it went on to become a 20 bagger. So he saw how having huge multi-baggers, 20 bagger, 30 baggers, something like that, can carry the returns of a portfolio. And I think it's really hard to get. We've talked about this a number of times on the show. It is really hard to get a huge multi-bagger purely based on valuation expansion or just more and more people getting excited about the stock. You really need the earnings improvement. And that is the
and
primary driver.
valuation.
Yeah, I mean, if you get both of those, yes, 100%. But the biggest driver in huge multi-baggers is going to be growth in earnings, unless you're buying at some ridiculous discount. But he goes on, when he's talking about fast growers, Lynch states, "These are among my favorite investments. Small, aggressive, new enterprises that grow at 20 to 25% a year. If you choose wisely, this is the land of 10 to 40 baggers and even the 200 baggers. With a small portfolio, one or two of these can make a career." And I think maybe it was just the fact that he saw how it can carry returns. Maybe he thought it was more intellectually stimulating to look for these ones. But ultimately, when you have these huge, huge winners, you only need a few to end up doing really well in aggregate.
Yeah, I agree. And I think one of the keys there, and he mentioned this, but you don't have it in your notes, is durable 20% growth as opposed to some stock. One of the red flags he looks out for is a company that has recently just accelerated revenue to the 50%, 60%, 70%, even 100%. He is afraid of that because I think, one, he's probably looking at that and saying, okay, well, is that consistent growth or is that some kind of catalyst or cyclicality that is really benefiting them for a short period of time? Or I think a lot of times this happened to the companies that were big winners during the pandemic. It is really hard to manage a company that goes from $100 million in sales or earnings to $1 billion within a couple of years. That can lead to a lot of chaos and uncertainty.
Yeah, it's pretty simple. It is hard to grow north of 50% on the top line for a long time. Like competitors will come for your business. It's hard to manage a business that way in terms of like employees and the
Hiring,
actual company and hiring. And it's a lot easier if you can just get like 20% growth over a long period of time. He talked about this a lot, which is he doesn't necessarily want an industry that's growing fast. He wants the fast grower in the slow growing industry. The market share taker in a stable sector is much more attractive to him than the high flyer where everyone else around them is competing for the same business. So anyways, let's talk about trying to identify companies before their growth stage. You got some notes down here on this. What excited you about this segment, and what were some of your takeaways?
Yeah, so he talks about this over and over in the book. It's something I really want to take for my own investing style. I think it's something I hadn't really articulated before, but it's something that I think we should focus on more and more, and is looking at researching a company's growth stage and whether you can predict anything about its future growth. I mean, a small company with predictable earnings growth of 20%, like we just mentioned, is the recipe for the 10 or even the 100 bagger. Two examples highlighted in the book are La Quinta and Taco Bell. Remember, this was written in 1990. So they had a growing restaurant concept, Taco Bell, and a growing hotel chain, La Quinta, that were concepts back when Lynch was investing. He likes physical retail concepts that have shown strong returns in a certain region and are planning to expand around the country. If you can get a predictable 15% return on invested capital, ROIC, and you have the opportunity to go from 200 to 2,000 stores, that stock might be a buy. Now, there are two keys to this type of investment making research, according to him. First is finding out the why for what makes it so successful in its region. So for La Quinta, it was an innovative model that took out some of the costs bloating other hotels, allowing it to offer travelers a good hotel room at a much cheaper price. And competitors would be behind because they can't remodel their existing locations overnight. It just takes so much time and you don't have the money. You can't spend it all in 1 year. The second key is seeing if the concept works in another region before investing. He highlights that Taco Bell proved it could work outside of its first market, but that a restaurant chain in the Boston area where he lived did not work when it moved to other areas, but Lynch invested in that Boston area restaurant before it proved unit economics outside of Boston, and he lost money. I think there is a lesson there for sure. If a concept works in 2 separate regions, it will likely work in 10. And if it works in, maybe if you're thinking about a global company, if it works in 2 countries that are pretty different, it might work, around the globe. I think restaurants are the quintessential winning stock in this category. Really. See some of the big winners of all time: McDonald's, Chipotle, Starbucks. I mean, a lot of times food concepts don't travel or they stay in a local area. But if management teams decide to expand and prove that the whole country enjoys the concept, think about young brands, Pizza Hut, Taco Bell, KFC. There is a long runway for reinvestment. And then you have another Chipotle. Now, I think a question I didn't write down here is what companies have proven that today. I have one. I think it is Kava.
I thought you were gonna go with something else.
But Kava, I think almost everyone has identified that as well. So that one seems like a rock solid runaway for reinvestment. I'm not sure that Peter Lynch would buy at this price because I think it's trading at north of 10 times sales for a restaurant concept. So I think almost all the future growth is getting priced in as they try to get to 1,000 restaurant locations. But I'm curious, do you have any either recent winners or ones that you're looking at now that maybe fit this criteria?
I think one that came to mind as you started talking about what it looks for here is Portillo's. It's something that it's kind of on the cusp, right? Where it's done
It's a little
really well in
riskier,
the Midwest,
yeah.
and they're starting that expansion into other regions. So if I were someone interested in Portillo's, the main things I'd be looking at is the per store growth, or even just the anecdotal stuff, like reading about any sort of magazines or local newspapers that talk about Portillo's, whether or not there's good buzz around those stores when they're put in, and can they last? Because there's always the sort of honeymoon effect where Portillo's goes in initially in a new market, and anyone that's from the Midwest that knows their stores, like, oh, they're excited about it, but does it have lasting success in those markets? They are in the process of that expansion, and I would pay a lot of attention to how those new stores do on an ongoing basis and whether or not they're able to produce positive comps. If they do start to have success, I would say that's probably at the top of my watch list restaurant wise in terms of any sort of retail stocks to own. Because it's unlike Kava, it is not priced in.
It's not as expensive, yeah. And full disclosure, I do own that in my portfolio now. I would say, yeah, it's definitely one where I think they've probably proven, given the average unit volumes at the non-Chicago area locations, they've probably proven that there is demand for these type of stores and they have good margins, but it is still a little bit to be determined compared to someone like Kava, as Portillo's has had way more inconsistent same-store sales growth. And one thing I'll probably be doing is just kind of looking at one of the areas. I think Dallas is one of the biggest new areas. Just go on Google Maps and search the restaurants and look at the reviews and see what people are saying. I mean, the internet can be beautiful sometimes like that. And I think today that's something that a Peter Lynch style investor would be doing.
Yeah, I think it'd be even better if you could get boots on the ground as well.
We got to get you moving to Texas, and then maybe we can.
Reviews, I don't know. The people that write reviews are always, it's never the middle of the it's never the middle of the pack. It's people that have strong opinions one way or the other. So
True. You can figure out what people are complaining about, though. And if management's talking about that, then maybe that lines up. Because I know, just for example, on Portillo's again, the management's talked about improving their drive-through experience and that they said they've been lacking in some of their operational efficiencies. Now, if the reviews line up with that or they have something completely different they're worried about and management's not focused on that, well, that could be a concern.
yeah, let's talk about the perfect company. This is what he calls the greatest company of all. That I have this in quotes here, but in chapter 8 of his book, he describes, and by he, I'm talking about Peter Lynch, he describes the 13 attributes that he looks for in a stock. And then at the end, he briefly goes over one example of what he would call the perfect company. And it's if you're interested in learning how to write a good one-pager, I recommend just looking at that specific segment. But we're going to go through the 13 attributes that he thinks are important, and we can talk about, maybe we can give our thoughts on whether or not it still applies today and what we can take away. So I'm going to go number 1 here, and this is the first attribute, in quotes, it sounds dull, or even better, ridiculous. He really looked for companies that had very vague or dull names that would not attract people to him. And the example he uses here is Pep Boys, Manny, Mo, and Jack. That is, I did not know Pep Boys had all 3 of the names after in the company name. So it's
Yeah, is that still
funny.
publicly traded? What?
I don't know.
I'll look it up right now.
But it ended up being a really good performer for him. And so the difficulty is we unfortunately don't have the names that existed a century ago where it was, like Standard Oil or very descriptive names. They're more like esoteric, like NVIDIA or Uber. Like no one really knows what those mean. So unfortunately, we get a lot of one-word esoteric names. But
I have something
there's still
on
some
here.
vague ones. Yeah. Go ahead.
On Pep Boys, you'll never guess who has acquired them in 2016. I guess almost 10 years ago now. Icon Enterprises.
Really?
Yeah. Probably hasn't done too well for them given how the troubles they're going through, but
yeah,
interesting.
Yeah. The second one here is not only does it sound dull, but it does something dull, something that is not sexy at all. He goes through a couple examples there, but I'm sure you can think of your companies here. One that came to mind for me is Nelnet. It's a company we own. They used to originate student loans. It's not very exciting. It's a pretty dull business. I really can't think of servicing and originating student loans is pretty boring. And anytime
or another
we tell
one
people
I like
about it, they don't care.
Yeah, another one that pops to mind right now, WD-40. Pretty boring. It's done really well over the long term. It's at a pretty premium price now, but they sell WD-40. That's what they do.
The third one here, it does something disagreeable. Now, initially, I kind of thought, when I read the title, I thought sin stocks, like Philip Morris, like selling cigarettes or whatever. But he calls out a company called Safety Clean, which goes around to all the gas stations and provides them with a machine that washes greasy auto parts. So he was talking more like disgusting type of companies, people where they don't really want to know about the operations. I don't have any that come to mind.
It's like where a company goes, we got to take care of this. I don't want to deal with this mess. All right, I'm going to hire you. Whatever the price is, quote me.
Sewage companies are a good example.
Waste management.
Yeah, waste management, exactly. The fourth one here, and this is one that I don't really spend much time on anymore. He says it's a spin-off. So he pays a lot of attention to spin-offs. I can't remember the last time I really invested in a spin-off. There really aren't even that many spin-offs.
I feel like, I was going to say, are there that many? I mean, one that comes to mind would be Topgolf Callaway. Could be some opportunities there if you like one of those divisions and they are going to spin something off. But I think private equity has ruined this a bit, where they're the ones scooping up the spinoffs.
Yeah, that's a good point. I know 3M is doing some spinoffs right now, but it's kind of an industry I'm not that familiar with.
Or I think Kellogg did a spinoff and separated themselves out. Maybe the big tech one's coming if the regulators have their way, but that might not be for a few years. But that could be one that he's looking for, because wasn't the key, tell me if I'm misremembering this, is that people are forced to sell the
Yeah,
spinoff.
that's part of it.
Okay.
And it's usually like people get attracted to the spun off company, but oftentimes it's the company doing the spin off that ends up benefiting more. Like I remember reading a study that the returns are typically, on average, the returns are better for the company getting rid of the business than the business that's spun off. And maybe it's because you spin off the most exciting part or whatever's hottest in the company, whatever it is. I guess uh, IAC does this frequently, or they
Right.
used to.
Yeah. Yeah. Maybe that's why the reputation hasn't been that strong lately because, or sorry, that category hasn't been that strong because that company hasn't done that well to the detriment of me, who was a shareholder that lost a little bit of money owning them.
All right, number 5. The institutions don't own it, and the analysts don't follow it. Now,
Classic.
yeah, I mean it's just less coverage. It's pretty rare. I found that it's quite rare to find a company that has no analysts anymore. Um, it's just like I feel like the coverage is so broad these days that
Yeah. Or even someone's talking about it online, but there are so many companies around the world. There is so much information now that there are people are like, well, everything's priced in. There is too much information for everyone to be reading, or even if you divide it up, if you had the whole investment world as a team of analysts, there are still pockets that are going to be miscovered or undercovered.
yeah. All right, number 6. The rumors abound. It's involved with toxic waste and or the mafia. Now, I don't think this one quite applies as much today because the mafia, unless I'm wrong, the mafia doesn't seem to have as much
They're just better at
influence.
covering it up.
Yeah, it could be.
No, yeah, it's definitely doesn't. Yeah, I mean maybe sin stocks a bit, but
he calls out like the casinos and how they were basically like he liked when people would say like, oh, that's run by the mafia or whatever, because like, there were opportunities there where it wasn't the case. And one of
what
those
about
was
Mexico?
he
Hey,
talks about the
what about
casinos. Oh, maybe, yeah,
Mexico?
you could replace it with the cartel. I
Yeah.
guess now a lot of people just call Mexico uninvestable because they say, oh, the cartel, has too much influence or whatever. But there are a lot of opportunities down there, it seems like. So maybe that's the new one here. The 7th one he calls out is there's something depressing about it. I like this one. He uses a funeral home roll up as an example. I think it was called Service Corporation International, which talk about a vague name. Um, People just don't want to talk about that kind of thing. It's funeral homes, especially. It's a business that I doubt a lot of VC backed companies are trying to get into. It's boring. The part it's an element of the world that people don't like being involved in. So yeah, it makes sense that you could have, if you have the right capital allocator in a business like that, the returns can certainly be there. Any thoughts on this one?
Yeah, I think that makes sense. I'd almost tossed insurance in there because people just find it so boring and also depressing just because a lot of the times it's dealing with things that happen that are bad, right? And I'd also maybe think of there's a terrible narrative out there, connotation, whether you disagree with this or not, is like data tracking, analytics on users online. I feel like that's one that comes to mind as well, where people just get really grossed out or they don't like that at all. And then a classic one would be tobacco, but I think you're going to be talking about the next categories. That's for this one.
Yeah, number 8, it's a no growth industry. He says, he has a quote here. It says, in a no growth industry, especially one that's boring and upsets people, there's
Philip
no
Morris.
problem. Yep. There's no problem with competition. You don't have to protect your flanks from potential rivals because nobody else is going to be interested. Yeah, I think uh, cigarettes is definitely an example here. In fact, this is in not even a no growth industry. It's a anti growth industry, I believe, at
Yep,
least
and
in
I
terms
think
of
he used
volumes.
Philip Morris back in 1990 as an example, where it's something like, oh, volumes are declining by 2%, but earnings are actually growing at 6%. And that can continue for a while. Now, today, I think in the US, they're declining at 10%, so that might be a bit more sketchy for Peter Lynch as someone to invest in. But yeah, that's a classic one, and no one cares about them, and they're going to permanently trade it really close. The good thing about these ones is that the valuation is not going to be demanding. At least I think.
Would you still call nicotine consumption generally, like as a broad category, would you still call that a rational? The competition in that space, would you still say it's rational?
Outside of vaping.
Vaping counts.
Okay, well, that's a small part of it, but the only one that's irrational is vaping.
Okay. Yeah, that's fair. All right. Number 9, it's got a niche. So, I don't know, really carves out its specific sector or carves out a specific demographic within an industry. Number 10, people have to keep buying it. This is less like, I don't know. He talks a lot about, toy companies or, businesses in the retail space, whereas today so much of the market, it seems like, is dominated by recurring revenue businesses. So it's a little more common today, but back in the 1990s, software as a service wasn't so commonplace. So a lot of the times you had to try and find businesses where it's a repeat purchase, like a Gillette razor or Coca-Cola, something like that, as opposed to just buying something one-off.
Yeah, it's the classic one of buying a Coca-Cola every day, which I wouldn't condone. It's pretty unhealthy, guys, as a listener. But versus, and the other extreme example is buying a couch or a bed. You do that once every 10 years, maybe even longer.
The 11th one here is it's a user of technology. I thought this was interesting because you always think about the company that's innovating and building out the technology, but he was talking about if there's a company that can be benefited by the new technology and shave off a couple percentage points on their costs, they can really inflect margins. So I guess maybe a good example here is what companies would most benefit from AI? Is it companies that have huge customer support staffs, companies that, something like that? Trying to identify the winners or the beneficiaries of that kind of development might be better than trying to find the winners in AI.
It's kind of the second order effects. One that came to mind that might be a little different is someone like Netflix that benefited from cloud computing, but not necessarily was as much of a technology company as people thought, even though, it did have the quote unquote algorithm that people still love to hype up. And they did have the streaming tech on their end that made them better than other people. But I think they were more of a user of technology, and that allowed them to vastly improve the customer experience.
Yeah, that's definitely a good example. Number 12, the insiders are buyers. So here's a quote from him, and I absolutely love this quote. When management owns stock, then rewarding the shareholders becomes a first priority. Whereas when the management simply collects a paycheck, then increasing salaries becomes a first priority. I have noticed that as I've evolved as an investor, at least since I've started, I have started to put way more emphasis on insider ownership, because if you're a mercenary CEO, you've been working at a different company, you get a nice cushy job as an executive in whatever, some bigger company. Your first priority is making sure you continue to get a paycheck. It's probably what most human beings would do if they were put in that position. But if you own a huge chunk of the stock, and it's important to qualify what good insider ownership is. If someone owns 1% of the stock, but they're independently wealthy and they don't really need it, or their salary makes up the majority of their compensation, they're getting huge options packages no matter what, that's not great insider ownership. If 95% of someone's net worth is tied to the value of their equity, then there is all the incentives in the world that are aligned with you. Like, they are perfectly aligned to benefit you in the same way it would benefit them.
Yep. And that's why when we look at companies, people like to look at how the executive team is getting compensated. And if they're getting stock, it's a big difference between we're giving you restricted stock units no matter what, versus you have performance hurdles for getting various stock units, and looking at a company that The guy might have a bunch of stock options, the CEO might have a bunch of stock options, but if they're selling them every month and it's really just one one extra step to getting cash that has no insider ownership, that's really not the same. And I'd be curious, with the rise of these stock option and modern stock option packages, what someone like Lynch would think about it. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on 1,800 stocks. Want to see NVIDIA's data center revenue? FinChat's got it. Like to track Spotify's premium subscribers? They've got that too. And they just added ETFs to the platform as well. The breadth of FinChat's data is truly one of a kind. We use FinChat every day, and I've personally been using the AI Copilot more and more to summarize earnings calls and conference transcripts. To get 15% off any paid plan, go to finchat.io/chitchat. That is finchat.io/chitchat to get 15% off any paid plan today. The link is in the show notes.
Yeah. Number 13, pretty simple here. The company is buying back shares. This is one we followed for a long time. And when you see an inflection in the buyback, when they start to really put more money towards it, especially I've noticed when a company has like a dual capital allocation strategy where it's like debt pay down and like continuous debt pay down and buybacks or something like that, or even like dividends and buybacks, or some combination of the three. When they start to skew more towards the buybacks, that for me is a big signal. Like if they're willing to put a pause or slow down the debt payments in favor of the buybacks, it shows you what they think of the security at the time. Which of these 13 attributes do you like the most, and which one, if any, do you want to start prioritizing more in the future?
Okay, I like buying back stock, insider ownership. I like people have to keep buying it, because I think even today, when you talk about company moving from small to larger, like that can really help in your returns. I know it's not fundamental analysis, but that's beneficial if you buy a small company that's going to graduate after you see this earnings growth inflection. I like no growth industry. I like the first three, sounds dull, it does something dull, it does something disagreeable. I like the stuff where people either get turned off by it just by hearing what it does. For example, for me, I know I'm going to be the stuff in my own portfolio and watch list comes to mind. So really, I know the listeners can probably, hopefully, have stuff for their own portfolio. It's not going to be the exact same in mine, but GoGo comes to mind for those three. People initially think about it with that horrible in-flight Wi-Fi service that they used to own. The name is weird. It doesn't make any sense. And it does something kind of, I guess, not disagreeable, but people hate, they have a terrible association with internet on planes. That's what I'm trying to say. So that makes sense for that one to me. And I do like the names that are obscure, because when the stock's Chipotle, well, you know what it does. And everyone knows what it does.
Absolutely. I think the doing something dull, that for me is maybe something I'll prioritize more in the future. Especially with like financials, it seems like a lot of people just don't want to do the work with financials, or they just, it's boring. They think, how fast can it really grow? But Ally, for example, has been one of my best investments of the last year or 2 years. And it was just, the thesis was pretty obvious. I thought it was there, very clear. And people just ignored it because it was, in most of the time, they would just ignore it because they just lump it in with banks. And obviously it is a bank, but it grows a little quicker because it offers people a better savings rate. I love companies like that, situations like that. So a dull category is a market share taker in a dull category is something I'm going to try to look for a little more.
Yeah, I think this is related to what he's talking about, but it reminds me again, you just talked about it here, it reminds me of when we talked about with Ian Bezek on Mexican stocks, is when you mention a sector, a country, a specific company, and 90% of the people immediately have some comeback like, I never invest in a financial, it could blow up, or I never invest in Mexico, the cartel, it's dangerous, blah, 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 blah. And you are confident that that's kind of nonsense and you have pretty high conviction in that, well, a lot of people are disregarding it for no reason. And if you're right, you could be a good there could be a big opportunity there.
Exactly. All right. Next segment, we had stocks he avoids. We already talked about that a little bit. Just it's the hottest thing, and whatever is the hottest in the market, he tends to avoid it, and he keeps it really simple. That's what he says. Any stocks that come to mind other than the big AI?
Other than Nvidia? Ooh, other than Nvidia, okay, Costco, Chipotle, some of these retail or restaurant concepts that are getting very premium multiples. The expectations are high because they are great businesses, but it's almost like they're getting priced like they can do no wrong. And there is definitely low risk to the Costco business model, but I don't think there's low risk to the stock right now. I do not think he would be buying Costco.
No, I agree. All right, let's talk about this other one, which is sort of the valuation side of things, because valuation is not the first thing that comes to mind when I think Peter Lynch, but it's something that he does talk about in the book. So let's go through it. How does he look at valuation?
Yeah, one thing, he invented the PEG ratio. A lot of people hate on the PEG ratio, and I think that's because earnings growth is hard, and I'll get into what it is. And some people, you can slap on any growth rate you want and say, "Oh, the PEG ratio is low." But here's how he did it, and I think it's a good rule of thumb to kind of think about when looking at a stock. Quote: assume we are comparing two different stocks and both have a price to earnings ratio of 30. On the surface, they may look the same, but now let's look at the growth rates. Let's say company A is growing earnings at 40%, while company B is growing at 15%. Company A has a PEG of 0.75, while company B has a PEG of 2. Lynch said that as a rule of thumb, he buys stocks where he believes the earnings growth will be greater than the PE. So if he buys a stock at a PE of 10, he wants it to grow earnings by 10% or more. If he buys it at a PE of 15, it needs to be growing at 15%. At 30, it needs to be growing at 30%. This is very simple on its face, but predicting earnings growth is hard. You can look at, as I mentioned, any company and saying, the future growth will be incredible. Shopify in 2020, it's going to grow at 100% forever, right? And then you can excuse yourself from buying 40 times earnings. Now, most of the times, even the great companies, Google's an example, right? Maybe the best company business model of all time, it grew earnings durably about, I think, 20 to 25% over a 20-year period after it went public. And yeah, there's exceptions to the rule of company, obviously, that's going from a 0% operating margin to 5%. Well, that's infinite growth. Or if it's at a cyclical trough or it's unprofitable. But I'm saying for someone that has not a margin inflection or a super depressed earnings where it's not a cyclical, I think this is a great rule of thumb. And here's a scary discussion question for you, Ryan. Is there a single large cap stock out there today that passes this test? I'm going to go up on the market cap list right now and maybe look at some for you. Any come to mind?
Oh, where the next year's earnings growth will be higher than the current PE.
Yeah, I'm going to go through the list of the largest companies by market cap in the world. Apple.
No.
Nvidia.
No.
Microsoft.
No.
Alphabet.
No.
Amazon.
No.
Low chance.
But
low chance.
Yeah, the earnings is a little weird there, but I'd say no.
Meta.
Not anymore.
All right, skipping Berkshire Hathaway, but I should note, about to hit $1 trillion market cap, big milestone. TSMC.
I don't really know the earnings multiple there, but
okay, let's go through ones that you might know. Visa.
No.
MasterCard.
No.
Costco.
Absolutely not.
Coca-Cola.
No.
Yeah, see,
are they that high on the market cap list?
No, I was just going down to ones that people would recognize. They're 31st, $300 billion market cap.
Okay. One that comes to mind for me, maybe Paycom. It's not a large cap by any means, but
yeah,
they, I think, trade at roughly, I mean, it's earnings, which is not the actual figure you should use for them, but I think it's like 15 or 16 times earnings, and there's the possibility that they could grow earnings faster than that.
Yeah, I think that's scary to me, that his quote doesn't really hold up for a lot of these companies. I think not that it's a bubble, but I don't know how many large cap stocks you'd be buying right now.
Well, we have longer time horizons than he did.
Yeah, exactly. There's a lot of excuses we can make. Hopefully for any listener, that's a sobering look at things. And I know people are averse to the PEG ratio because you're predicting earnings growth, but again, good rule of thumb. Now let's close things out with the last section on avoiding macroeconomic doom. I'm not going to read the full quote, but in the newsletter, there's a very interesting quote. He's kind of funny about it. He has some good perspective in the book, and I think it's good to close out the episode on this. Talks about, an ominous message repeated over and over. And this is, again, in the 1980s. And it's the drumbeat around the M1 money supply. He talks about how he doesn't really know what it is. He talks about how everyone seems to care, but no one really seems to know what it means. It's growing too fast. Now is it growing too slow? And then he says, now we've suddenly heard nothing further about the M1 money supply, and our attention is diverted to the discount rate that the Fed charges member banks. How many people know what this is? You can count me out once again. How many people know what the Fed does? And he said something about how everyone thinks it's a brand of whiskey or a native reservation or a wildlife preserve. Some people think it's a prison now, right? We're going to lock you up at the Federal Reserve. I think that's because there's that movie from Will Ferrell and Mark Wahlberg.
Did you say whiskey brand? Is that what he said?
Yeah, that's not bad. It's not a bad joke.
Funny.
But I think people have focused to M2 now. Not sure why. But these are things that the same macroeconomic doomers have been talking about right now. They care so much about what the Fed's going to do and how it's going to impact loans and blah, 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 blah. They care so much about the M2 money supply, how it's impacting inflation, blah, blah, blah. I think it's a crapshoot. I think he thinks it's a crapshoot. I think he actually, in this quote, is understating how much he actually understands about how the Federal Reserve and the Treasury and kind of the macroeconomic stuff works. But he's saying he doesn't understand it because he knows that it's just going to cause him harm when trying to buy quality companies at a reasonable valuation. Is the macro stuff fun to talk about? Yes. I like talking about it sometimes. Inflation's fun to talk about, I guess. But should it impact your investment portfolio? I don't think so. And Peter Lynch, given his track record, is another person, along with Buffett, that says almost all the time, ignore the macro fear.
Yeah. All right. Let's wrap things up. 2 takeaways from studying Peter Lynch. We can make them quick. Do you have any on top of your mind?
Let me think while you're talking, because you have yours written down, and then I think I can come up with 2, though.
Okay. Number 1 for me is stay alert. He talks all about boots on the ground and analyzing just the world around him. And Jason Moser once said, we interviewed him like when we first started the podcast, and he said, investing is just all about understanding the world around you. And I think that's 100% true. For me, I'm going to try to start doing this. Pay attention to what services provide value to me. Pay attention to what I'm spending money on. So the bank account check, like going through, reviewing my bank account and seeing where I'm allocating money on a regular basis. And if that is a publicly traded stock, dig into it a little bit. Use that as sort of lead generators. Second one for me, you don't have to be super concentrated. This is something that I've always kind of been on the fence on. Do I want to be super concentrated? Do I need it in order to outperform? I think it's more fun to own. I think it's more fun, and it's proven that you can do just fine with 20, 30 stocks in your portfolio. Doesn't mean it needs to be equal weighted. You can own a bunch and just let your winners run and evolve your position or adjust your position over time as your shareholder. So I think I'm getting more and more comfortable with the fact that I can add more than 10 stocks in my portfolio.
Yeah, I think it's a difference between having 100 at each at a 1% position, and again, letting the winners run. People talk about the Motley Fool, and you hear a lot of pushback. Well, they've recommended 300 stocks. The key is they've said never sell our recommendations, and then you get Netflix, which ends up being 50% of the portfolio, makes up for a lot of those losses, and that's where the returns come from and why they beat the market over the long term. Peter Lynch, I think, is similar. My 2 takeaways. First one, big one, look at the reinvestment runway or look at the growth runway, especially for physical retail concepts that can expand nationally or internationally. Then second, it's one we talk about a lot. It's one that people have probably heard of before, and you just talked about it. Let your winners run. Unless, again, the thesis breaks, but assuming the thesis doesn't break, unless it is becoming a huge mega cap stock at a premium earnings multiple, you probably should just keep letting it run. All right, I think that's going to do it. Ryan, anything else before we close out this episode? I'll maybe give a tease on some of the upcoming potential episodes we're going to do.
What? No, I got nothing else. It was fun studying Peter Lynch. What investor do you want to do next? Any idea?
I was going to say David Gardner, but it's too similar, so maybe we should save that for a couple quarters down the line. I got nothing.
What about the Ackman, the general?
The general? That could be fun. I know he's kind of become more of a, maybe he would describe it a Renaissance man now. Some people might call it the general, focusing on military strategy, but we'll obviously focus strictly on his investing strategy. That could be a fun one. He's public about it, and it's definitely stuff that we understand, All right. Yeah, that could be a good one. I like it.
Let's take us out.
Yeah, as a tease for future episodes, I'm going to be doing a research report on Remitly. Interesting one in the remittance space. We're hopefully going to have some interviews on Rocket Lab, little electric vehicles update, potentially some other ones, which could be fun. And Ryan is going to have another stock research report, although I don't think you've picked out what it is. But yeah, a lot of fun stuff. We're going to be studying great investors, studying stocks, interviewing analysts, and more as we hopefully bridge the gap between last earnings season and this one. All right, let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for listening. Hope you learned a lot. We'll see you next time.